Welcome to Cross Currents, where we explore today's challenging questions. Tonight's central question: are wealth taxes an effective way to reduce economic inequality? This sparks considerable debate on fairness, economic strategy, and societal well-being. To discuss this, we have Dr. Samuel Green, an economist who sees wealth taxes as a vital tool for equity, and Ms. Isabella Rossi, a financial analyst arguing such taxes are impractical and detrimental. We'll have opening statements, rebuttals, a moderated discussion, and closing remarks. Dr. Green, please begin.
Thank you, Elena. It's a pleasure to be here to discuss such a critical issue. I believe wealth taxes are not only a just, but also an eminently practical mechanism to address the severe concentration of wealth we see today. This concentration, if left unchecked, poses significant risks to our social fabric and economic dynamism. Let's be clear. A wealth tax is a levy on an individual's net worth, their total assets like property, stocks, and bonds, minus any debts. It is fundamentally different from an income tax, which targets annual earnings. The current scale of economic inequality is staggering. A tiny fraction of the population holds a disproportionate share of global wealth. This isn't merely an abstract concern. Such disparity hinders social mobility, making it harder for individuals to improve their circumstances, regardless of talent or effort. It can also breed resentment and social unrest, undermining the stability we all depend upon. From a fairness perspective, it seems entirely reasonable that those who have accumulated extraordinary fortunes, often benefiting from societal structures and public investments, should contribute a modest portion back to society. It's important to note that wealth often grows at a much faster rate than income from labor, and it can be subject to lower effective tax rates under current systems. A wealth tax aims to correct this imbalance. The revenue generated could be transformative. Imagine investing these funds into improving our education systems, making healthcare more accessible, upgrading vital infrastructure, or funding crucial climate initiatives. Some argue this is about punishing success, but that's a mischaracterization. Rather, it's about rebalancing our economic system to ensure that it works for the many, not just the few, and that success is built upon a foundation of genuine opportunity for all.
Thank you, Elena. While I share the concern over economic inequality, I believe wealth taxes are a flawed solution, fraught with practical difficulties and likely to cause more economic harm than good. Firstly, the challenge of accurately valuing diverse assets, from art to private businesses, on an annual basis is immense. This subjectivity inevitably leads to disputes, high administrative costs, and potential unfairness. Secondly, there's the liquidity problem. Many wealthy individuals have their assets tied up in illiquid forms, like real estate or their own companies. A wealth tax could force them into disadvantageous sales, disrupting businesses and markets. The economic risks are also substantial. Capital is mobile in today's globalized world. Imposing a wealth tax creates a significant risk of capital flight, where wealthy individuals move their assets to countries without such taxes. This has been observed in European countries that attempted wealth taxes, leading to an erosion of the tax base. Furthermore, a wealth tax can discourage saving, investment, and entrepreneurship. If the fruits of success and risk-taking are subject to an ongoing levy on the capital itself, not just on the income it generates, it dampens the incentives that drive economic growth and job creation, ultimately affecting everyone. We must also remember that wealth is already taxed in various ways, through capital gains taxes when assets are sold, inheritance taxes when wealth is transferred, and property taxes on real estate. Adding another layer may be less effective than improving these existing mechanisms. Instead of pursuing a policy with such inherent drawbacks, we should focus on alternatives like fostering inclusive economic growth, enhancing educational opportunities to improve social mobility, and reforming our income tax systems to be more progressive and efficient.
Ms. Rossi has raised some commonly cited concerns, but I believe they are often overstated or can be effectively mitigated. Regarding capital flight, this is a manageable challenge with concerted effort. Increased international cooperation on tax matters, which is steadily growing, can significantly curtail avoidance. Furthermore, thoughtfully designed exit taxes can discourage individuals from renouncing citizenship or relocating assets purely for tax purposes, ensuring a fairer system. The argument about valuation difficulties also needs careful perspective. Governments already operate systems for valuing a wide range of assets for property taxes, inheritance taxes, and capital gains assessments. While not flawless, these systems demonstrate that valuation is achievable. Moreover, a modern wealth tax would typically apply only to the very wealthiest individuals, those with assets far exceeding a high threshold, perhaps in the tens of millions. This substantially narrows the number of valuations required and allows a focus on more liquid or easily accessible assets, at least initially. The administrative costs, while real, must be weighed against the significant revenue potential and the profound societal benefits of mitigating extreme inequality. The aim is not to stifle growth, but to ensure growth is more inclusive and its benefits more widely shared.
Dr. Green's faith in international cooperation and exit taxes is optimistic, but the historical record on collecting taxes across borders from highly mobile capital and individuals is challenging, to say the least. True global consensus and enforcement remain elusive. While valuation systems exist for other taxes, a comprehensive annual wealth tax on diverse global assets presents a far greater, more complex, and costlier administrative undertaking. The scope is different. Property tax valuation is localized, and inheritance tax is a one-time event, not an annual assessment of fluctuating global wealth. The idea of targeting only the quote-quote ultra-rich might sound politically appealing, but it doesn't negate the fundamental economic disincentives. These are often the very individuals whose investments and entrepreneurial activities have a disproportionately large impact on job creation and innovation. Even if only a few are directly taxed, the signal it sends can chill investment sentiment more broadly. The administrative burden and compliance costs would still be substantial, potentially outweighing the revenue, especially if capital flight is more significant than anticipated. We must be cautious that the pursuit of laudable goals, like reducing inequality, doesn't lead us to implement policies that ultimately shrink the economic pie for everyone, hindering the very prosperity we aim to share more equitably.
Dr. Green, Ms. Rossi highlights capital flight. How significant is this risk, and what specific, feasible measures could prevent it without undue burdens?
The risk is manageable. Robust exit taxes on unrealized gains upon emigration are crucial. Enhanced international cooperation on tax transparency, like the Common Reporting Standard, also makes avoidance harder. It's about ensuring fair contribution, not excessive burden.
Ms. Rossi, if not wealth taxes, what single policy is most effective for addressing wealth concentration?
Comprehensive reform of education and skills training, universally accessible and high quality. This tackles inequality of opportunity, a root cause of wealth disparity, by building human capital and creating broader pathways to prosperity, rather than redistributing existing wealth with harmful side effects.
Dr. Green, a brief question for Ms. Rossi.
Ms. Rossi, given that current capital gains and inheritance taxes often have loopholes favoring the wealthy, do you believe reforming these alone adequately addresses the scale of wealth accumulation at the top, which often outpaces economic growth?
I agree existing systems need reform to close loopholes and enhance fairness, perhaps by aligning capital gains rates with income tax for high earners. Perfecting these conventional taxes is more prudent than introducing a new, complex, and economically risky wealth tax. Focus on effective enforcement and targeted reforms.
And Ms. Rossi, a question for Dr. Green.
Dr. Green, can you name a country with a long-term, comprehensive wealth tax that successfully reduced inequality and raised revenue without significant capital flight, administrative issues, or negative economic impacts?
While some past attempts were flawed, countries like Norway, Spain, and Switzerland have forms of wealth tax. Norway's has coexisted with high living standards. Careful design is key. Appropriate thresholds, integration with other taxes, and robust international agreements. We can learn from past mistakes to design effective modern versions. To conclude, wealth taxes represent a vital instrument for fairness and societal progress. They offer a way to ensure that those who have benefited most from our economy contribute proportionately to the public services and infrastructure that underpin all success. The revenue generated can be dedicated to critical areas like education, healthcare, and green transitions, fostering a more inclusive and sustainable economy. The arguments against wealth taxes often overlook the feasibility of modern design and international cooperation. More importantly, they often downplay the profound risks of inaction. Unchecked, extreme wealth concentration erodes social cohesion, limits opportunity, and can ultimately destabilize our economies and democracies. A carefully implemented wealth tax is not about penalizing achievement, but about re-establishing a sense of balance and shared prosperity. It is a call for a society where wealth actively contributes to the common good, building a more equitable future for all.
In closing, while the goal of reducing economic inequality is one I wholeheartedly share, wealth taxes are simply the wrong instrument. They are practically unworkable due to valuation and liquidity challenges, and they carry substantial risks of capital flight and reduced investment. These are not theoretical concerns. They are lessons learned from countries that have attempted and often abandoned such policies. The administrative costs and economic distortions frequently outweigh any modest revenue gains. We have alternative, less harmful tools at our disposal, fostering robust and inclusive economic growth, enhancing educational opportunities, and reforming existing taxes on income, capital gains, and inheritance to be fairer and more efficient. Good intentions must not lead us to policies with damaging unintended consequences for the broader economy and job creation. Let us focus on strategies that encourage wealth creation and broad-based prosperity, rather than those that risk redistributing a shrinking economic pie.
And with that, our discussion concludes. My sincere thanks to Dr. Samuel Green and Ms. Isabella Rossi for their articulate and reasoned arguments on this complex topic today. We've heard compelling points, highlighting the tension between moral and economic arguments for wealth redistribution via taxation versus concerns about economic efficiency, implementation, and unintended consequences. Clearly, there are no easy answers. We hope this debate has provided our audience with valuable insights for further reflection on fostering a fair and prosperous society. Thank you for joining Cross Currents. Good evening.